For decades, the world has worshipped at the altar of Warren Buffett, the Oracle of Omaha, the undisputed king of investing, and his track record is incredible. Roughly 20% annualized returns over 50 years. If you invested with him, you became rich. End of story. But what if I told you that Buffett isn't the king? What if I told you that quietly, secretly, hidden away in a fortress of solitude on Long Island, someone else built a machine that makes Buffett's returns look average? Imagine a return of 66% every single year for 30 years. It's a number that shouldn't exist. It defies economic gravity. It's the financial equivalent of perpetual motion. If you had put $1,000 into this fund in 1988, you wouldn't just be rich today. You would have billions of dollars. This isn't a story about inside information. It's not about charismatic CEOs or Wolf of Wall Street sales tactics. It's the story of the greatest unsolved mystery in modern finance. The story of a mathematician who cracked the code, built the ultimate money-making machine, and then closed the doors to the outside world. This is the story of Jim Simons and the Medallion Fund, the real-life financial cheat code. To understand the machine, you have to understand the architect. And Jim Simons was the anti-Wall Street guy. He didn't care about P/E ratios. He didn't read the Wall Street Journal. He didn't even care about business. Simons was a pure academic, a superstar mathematician. In the 60s, he worked for the NSA, breaking codes during the Vietnam War. He later became famous in the math world for something called the Chern-Simons form, abstract geometry that ended up being crucial to string theory. He was a man living entirely in the realm of theoretical abstraction. But in 1978, at the age of 40, Simons got bored. He decided to try his hand at trading. When he arrived on Wall Street, he looked at the financial markets not as a place where businesses raised capital, but as a chaotic, noisy data set. The prevailing wisdom at the time was the efficient market hypothesis, the idea that you can't really beat the market because all known information is already priced in. Prices move randomly. Simons looked at that chaos and thought, no, that's not random. There's a structure here. It's just hidden beneath layers of human emotion, fear, and greed. He believed that if you could look deep enough into the data, you could find ghosts, patterns that repeated. He just needed the right people to help him hunt them. Simons founded Renaissance Technologies, and his hiring policy was simple yet radical for the time. No finance people. If you had an MBA from Harvard, Simons wasn't interested. He hired astrophysicists, string theorists, crystallographers, and crucially, experts from IBM who worked on speech recognition. Think about that. Why speech recognition? Because speech is noisy. It's full of mumbles, slang, and background static. The goal is to filter out the noise and identify the true signal, the actual words. Simons realized the stock market was exactly the same. It was a noisy conversation of millions of traders. He needed people who could ignore the noise and find the signal. It didn't work right away. For years they struggled. They tried mixing fundamental trading with math. They almost went broke. The breakthrough came when they stopped trying to understand why the market was moving and just focused on how it moved. They realized they didn't need to know if Apple just released a new computer. They just needed to know that when stock A moves up 2% on a Tuesday morning, stock B has a 52% chance of moving down 3 seconds later. They stopped being investors. They became data miners. In 1988, they launched the Medallion Fund. It became the ultimate black box. To this day, almost no one outside the firm knows exactly how the algorithms work. Even the scientists inside might only understand their specific piece of the puzzle. But we know the philosophy. Think of a casino. The casino doesn't need to win every hand of blackjack. They don't even need to win most hands. They just need a tiny statistical edge, the house edge. If they have a 51% advantage and they play millions of hands a day, the casino cannot lose over the long run. It's mathematical certainty. Medallion is the casino. They don't make big bets on the future of the economy. They make millions of tiny trades, sometimes holding positions for only seconds or minutes. They were among the first to utilize high-frequency trading tactics. They found correlations no human could see. Maybe a slight delay between the price of gold in London and silver in Tokyo. A human trader can't see that. A computer can see it, exploit it, and get out before anyone else notices. One former employee famously said, "Their system only needs to be right about 51% of the time. If you are right 51% of the time, and you trade billions of dollars thousands of times a day, that 1% edge turns into a river of money." But there was a catch to this incredible success. The Medallion Fund eventually faced a problem that every great trader fears. It became too successful. In the world of high-frequency trading, size is the enemy. When you are moving billions of dollars, you become a whale in a swimming pool. Every time you move, the water splashes. If Medallion tried to buy a stock, their sheer volume would drive the price up before they could finish the transaction, destroying their profit margins. This is called slippage, and Simons knew it was the only thing that could kill the machine. So in 1993, he did the unthinkable. He stopped accepting new money from outsiders, but that wasn't enough. The machine was printing money so fast that the fund kept growing anyway. By 2005, Simons initiated the Great Purge. He didn't just close the door, he kicked everyone out. He returned every cent of outside capital to investors. It was a move that shocked Wall Street. Funds usually beg for capital. Simons was forcefully giving it back. Today, the only people allowed to invest in the Medallion Fund are the 300 or so employees of Renaissance Technologies. This created a unique corporate culture, a sort of golden handcuff. If you work at Renaissance, you have access to the greatest wealth creation vehicle in history. But if you leave, you have to cash out. You lose your ticket. This ensured that the smartest minds in the world stayed loyal, and more importantly, it ensured they stayed silent. And their confidence is staggering. Hedge funds usually charge high fees, typically 2% of assets and 20% of profits. Medallion charges 5% of assets and a staggering 44% of profits. They charge that because they know, even after taking half your winnings, and even after forcing you to withdraw your profits every year to keep the fund size manageable, you'll still make more money with them than anyone else on Earth. Jim Simons passed away in the spring of 2024 at the age of 86. He spent the last years of his life giving away billions to support scientific research, autism awareness, and math education. He showed that the market isn't a magical place driven by intuition. It is simply a complex physics problem waiting to be solved. He started an arms race that has completely reshaped the global economy. Today, every major hedge fund, from Citadel to Two Sigma, is trying to replicate what Medallion did. They hire the same physicists, they build the same supercomputers, and they hunt for the same signals. Quant investing now dominates the market, accounting for the vast majority of daily trades. But here is the final mystery. Despite all the copycats, and despite 40 years of technological advancement, nobody has ever caught up to Medallion. The IRS investigated them, competitors spied on them, and academics studied them. Yet the black box remains impenetrable. The code is still running on Long Island, quietly printing billions for the smartest room full of people on the planet. It operates on a formula the rest of us will never see, finding patterns we will never understand. Jim Simons didn't just beat the market, he solved it. And then he took the answer with him.